Forex trading can be highly rewarding, but it also comes with significant risks. Many traders, especially beginners, fall into common pitfalls that hinder their success. Understanding these mistakes and learning how to avoid them is crucial for long-term profitability. From poor risk management to emotional trading, avoiding these errors can help traders build a strong foundation. In this guide, we will explore 10 of the most common Forex trading mistakes and how to prevent them. By following disciplined strategies, traders can increase their chances of success in the volatile Forex market. 1. Over-leveraging trades. Leverage allows traders to control large positions with a small amount of capital, but excessive leverage increases risk. Many traders misuse leverage, leading to rapid account depletion. Using conservative leverage levels, such as 110 or 120, helps manage risk effectively. Understanding margin requirements and potential drawdowns is essential. Proper position sizing ensures that traders do not risk too much on a single trade. A well-balanced approach to leverage protects capital and improves long-term success. Avoiding excessive margin exposure prevents forced liquidations. Responsible leverage management is key to sustainable trading. 2. Neglecting risk management. One of the biggest mistakes traders make is failing to implement proper risk management strategies. Risking too much per trade can lead to significant losses. Traders should never risk more than 1–2% of their account balance on a single trade. Setting stop loss and take profit levels ensures disciplined trading. A solid risk-reward ratio of at least 1–2 improves profitability. Diversifying trades across different currency pairs reduces overall risk exposure. Regularly reviewing and adjusting risk parameters enhances trading consistency. Effective risk management preserves capital for long-term growth. 3. Ignoring a trading plan. Many traders enter the market without a well-defined trading plan. Trading without a structured approach leads to impulsive decisions. A trading plan should include entry and exit strategies, risk management rules, and performance evaluation. Backtesting the plan using historical data ensures its effectiveness. Sticking to a trading plan prevents emotional decision-making. Traders should continuously refine their plan based on market conditions. Documenting trades and reviewing past performance helps improve strategy. A disciplined trading plan is essential for long-term success. 4. Chasing the market. Chasing the market occurs when traders enter trades too late, driven by fear of missing out, FOMO. This often results in poor entry points and increased risk. Waiting for strategic entry opportunities improves trade execution. Traders should rely on technical and fundamental analysis rather than emotions. Avoiding impulsive trades ensures consistency. Patience and discipline help traders capitalize on high-probability setups. Setting predefined entry rules reduces emotional trading. Successful traders focus on planned trades, not random market movements. 5. Lack of emotional discipline. Emotional trading leads to impulsive decisions that can harm trading performance. Greed can cause traders to hold onto trades for too long, while fear may result in premature exits. Developing a disciplined mindset helps manage emotions. Using stop loss and take profit orders ensures objective decision-making. Traders should take breaks after consecutive losses to regain composure. Keeping a trading journal helps identify emotional patterns and improve discipline. Practicing mindfulness and stress management techniques enhances mental clarity. Emotionally controlled traders make better trading decisions. 6. Overtrading. Overtrading occurs when traders take excessive positions without clear setups. This often leads to increased transaction costs and poor trade quality. Following a structured trading plan prevents unnecessary trades. Identifying high-probability setups reduces the temptation to overtrade. Setting a daily or weekly trade limit maintains discipline. Quality over quantity should be the focus of every trader. Overtrading often stems from boredom or frustration, so maintaining patience is key. Trading fewer but well-planned setups improves overall profitability. 7. Ignoring market trends. Trading against the trend is a common mistake among beginners. Trend-following strategies increase the likelihood of successful trades. Identifying market direction through technical indicators, such as moving averages, improves trade accuracy. Counter-trend trading requires advanced skills and higher risk tolerance. Following the trend aligns trades with the overall market momentum. Avoiding unnecessary counter-trend trades reduces losses. Understanding trend reversals and confirmations enhances decision-making. Trading with the trend increases consistency and profitability. 8. Misunderstanding economic events. Ignoring economic news and market events can lead to unexpected losses. High-impact news releases, such as interest rate decisions and employment reports, cause significant volatility. Checking an economic calendar helps traders prepare for market-moving events. Avoiding trades before major news releases minimizes unnecessary risks. Understanding how different currencies react to specific news enhances decision-making. Traders should adjust risk exposure during high volatility periods. Staying informed about global economic developments improves trade planning. Incorporating fundamental analysis strengthens overall strategy. 9. Poor trade execution and timing. Entering or exiting trades at the wrong time can lead to missed opportunities or losses. Rushing into trades without confirming setups is a common mistake. Waiting for technical confirmations improves trade timing. Using limit and stop orders ensures precision in trade execution. Avoiding market orders during high volatility reduces slippage. Patience is essential for optimal trade entries and exits. Reviewing past trades helps identify timing mistakes. Well-timed execution enhances trading performance and reduces unnecessary risks. 10. Failing to learn from mistakes. Many traders repeat the same mistakes without analyzing their past trades. Keeping a trading journal helps identify strengths and weaknesses. Reviewing losing trades provides insights for improvement. Learning from past errors prevents repeated financial setbacks. Continuous education through courses and mentorship enhances trading skills. Adapting strategies based on market feedback leads to long-term success. A growth mindset is essential for becoming a successful trader. Consistently refining trading strategies ensures ongoing improvement. Avoiding common Forex trading mistakes requires discipline, patience, and continuous learning. By managing leverage, controlling emotions, and following a structured trading plan, traders can enhance their performance. Understanding market trends and economic events further strengthens decision-making. The key to long-term success lies in learning from past mistakes and refining strategies. By implementing these best practices, traders can navigate the Forex market with confidence and consistency. Thanks for reading this guide on common Forex trading mistakes and how to avoid them. If you found this information valuable, don't forget to like, share, and subscribe for more trading tips and strategies. Stay disciplined, stay informed, and happy trading.